got 10-year yield. Whew, I mean, good Lord. This is called moving the move, okay?
Wow.
Wow. Now, okay, so this is called a multi-standard deviation move off the low end of the range. When that happens, there's a technical term for this. Shit hit the fan. That's what happened, okay? So that's a big problem. Something really, really wild happened with it.
Did you learn that in the econ department at Yale?
Yeah, it's like they gave me a B+ for that.
The shit hit the fan
Yeah,
terminology?
yeah, it did. I mean, it did. So what happens here is that the vol of bond market volatility starts to move. It's called the move index. I wrote about that this morning. Most people actually, even in this profession, don't even know what that is, which is appalling. It's like not knowing where the brake is on a car. But again, it's the most important thing you should be looking at is the relationship. We show this as the chart of the day, which is the relationship between Treasury bond market volatility, which is on the x-axis, and on the y-axis is high yield spreads. So now the x-axis, we're moving out. Okay, the move is moving out in Canadian accent terms, okay? And that just simply means that the world doesn't believe that the Fed is what? Dovish enough, all right? So they're like, I'll take your 10-year down. The low end of the range just went from 201 to 181 in a day. One day. Will you remember this for the next 20, 30, 40, God willing, 80 years that you do this if you're 20 years old and you're going to play the game till you're 100? Yeah, you're going to remember it because it doesn't happen that often. And it happens at this part of the economic cycle, where all of a sudden everyone's long rate cuts, and the Fed actually hasn't cut enough relative to the incoming economic data that the market's starting to reflect upon as a high and rising probability. So again, that's very bad. Okay, as that chart, as you can see, all those dots are not fake news. Those are all years where corporate credit became a huge market risk and moved up and to the right of that chart. So again, not fake news. All those years happened. The big similarity that you have this time is that there's a lot of corporate credit, similar to 2000 and 2001. The last time tech was the biggest component of corporate credit. Imagine that. And what are tech earnings this morning? Actually, this morning, I should have hit on this at the beginning. Nobody's going to talk about this because they keep saying, oh, dude, the earnings are better than expected. Every single day this week, earnings have gotten worse. So they went from up 4 to up 3 to up 2 to up 1.88. And tech's now down 6.5 or more. Some of the worst earnings have to do with some of the worst credits. So again, energy earnings are negative, materials are negative, and tech are negative. What else is going to be negative next? Financials are going to be negative. Could be next quarter when they finally admit the truth. So again, lots to think about there.